Hello students, welcome to the lecture on leverages, and after the lecture we will be able to learn the following objectives. Explain the concept of leverages, discuss equity shares, describe the preference share, explain the debenture, define the working capital. Let's start with a brief introduction to the leverages. Leverage has been defined as the action of a lever and the mechanical advantage gained by it. A lever is a rigid piece that transmits and modifies force or motion where forces are applied at 2 points and it turns around a third. The physical principle of the lever is intuitively appealing to most. It is the principle that permits the magnification of force when a lever is applied to a fulcrum. The term leverage refers to an increased means of accomplishing some purpose. Leverage is an advantage or a disadvantage which is derived from earning a return on total investment, total assets, and which is different from the return on owner's equity. It is a relationship between equity share capital and securities and creates fixed interest and dividend charges. It is also known as gearing. Let's now discuss the concept of the leverages. Leverage allows a financial institution to increase the potential gains or losses on a position or investment beyond what will be possible through a direct investment of its own funds. There are 3 types of leverage balance sheet, economic and embedded, and no single measure can capture all 3 dimensions simultaneously. The first definition is based on balance sheet concepts, the second on market-dependent future cash flows, and the third on market risk. Leverage resulting in an overall exposure to loss that is a multiple of a direct investment in the underlying portfolio. 2-layer securitizations or re-securitizations, such as in the case of a collateralized debt obligation that invests in asset-backed securities, can boost embedded leverage to even higher levels. Embedded leverage is extremely difficult to measure whether in an individual institution or in the financial institution. Measures of leverage. The most widely used measure of leverage for regulatory purpose is the leverage ratio. Leverage can also be expressed as a leverage multiple, which is simply the inverse of the leverage ratio. Types of leverages. Leverage can be defined as the employment of an asset or a source of funds for which the firm has to pay a fixed cost or fixed return. Because of the incurrence of fixed cost, the net income and the earnings available to the equity shareholders as well as the risk gets affected. Operating leverage. The operating leverage takes place when a change in revenue produces a greater change in EBIT. It indicates the impact of changes in sales on operating income. A firm with a high operating leverage has a relatively greater effect on EBIT for small changes in sales. A small rise in sales may enhance profits considerably, while a small decline in sales may reduce and even wipe out the EBIT. Naturally, no firm likes to operate under conditions of a high operating leverage because that creates a high-risk situation. It is always safe for a firm to operate sufficiently above the break-even point to avoid dangerous fluctuations in sales and profits. The operating leverage is related to fixed cost, capital gearing effects. A company's capacity to maintain an even distribution policy in the face of difficult trading periods which may occur, dividend policies, and the building up of reserves. Financial leverage. The proportion of debt in the capital structure of a company is limited by 2 factors: selection of key variables and formulation of a set of equations relating the outcome to the independent variables, probability distributions to each variable, evaluation of each variable by using a generated pseudo-random number, computation of the outcome by using the above evaluated variables. Advantages of financial leverage. The advantage of trading one equity is that it makes possible for a company to distribute higher dividends per share than it would have if it has been financed by stock alone. The advantages and attractiveness of trading on equity for the owners of equity capital are all too apparent. Some of these have already been explained while discussing the requirements for trading one equity. Limitations of financial leverage. It may cause dividends to disappear altogether and, indeed, may be responsible for the insolvency and even bankruptcy of a corporation. Companies enjoying a fairly regular income can employ borrowed funds more safely than those with widely fluctuating incomes. Beyond a certain point, additional capital cannot be employed to produce or turn in excess of the payments which must be made for its use, or sufficiently in excess thereof is justify its employment. The bigger the amount of funds borrowed, the higher the interest rate of corporation may be forced to pay in order to market its successive issues of bonds. Such increase in interest rates, if carried far off, may offset all the advantages of trading on equity. Combined leverage. It is the product of operating leverage and financial leverage. Combined leverage equals to operating leverage into financial leverage, which is equal to the percentage change in EBIT, percentage change in sale into the percentage change into EPS, percentage change in EBIT. High operating leverage and high financial leverage combination is highly risky for business. Good combination is that in which lower operating leverage with financial leverage. It is a leverage which refers to high profits due to fixed cost. Financing sources. There are two main categories of sources from which the businessman can get the required funds for the business: internal source and external source. We know that to start a business, the businessman either invests his own money or borrows from outsiders or uses both the sources. When the businessman invests his own money, called owner's capital, and retains a part of the profits earned in the business, it constitutes the internal sources of finance. A sole proprietorship, a form of business organization, has very limited sources from which it can arrange funds for the business. Own savings, friends and relatives, money lenders, finance companies, manufacturers and suppliers, retained profits. The same sources of financing are also available in case of partnership firms. In both sole proprietorship and partnership form of business organization, long-term capital is generally provided by the owners themselves by way of investing their own savings and retaining a part of the profits generated by the business, and the rest of the above sources are mostly used for their short-term financial needs. However, in case of companies, the following are the usual sources of finance: capital market, financial institutions, public deposits, commercial banks, leasing companies, investment trusts, retained profits. Retained earnings, plowed back of profits. The profit earned by the company is diversified in three ways: taxation, dividend payments, and plugging back profits. Retained earnings are the profits generated by a company that are not distributed to shareholders as dividends but kept as a reserve for fixed capital as well as for working capital requirements for expansion and development schemes. Such a source of finance may be used by the company for the following purposes: for expansion and the growth of the business, for strengthening the financial position of the company, for meeting various working capital requirements of the company, for redemption of old debts, for replacement of obsolete assets and modernization. The amount of retained earnings in a company depends upon the following factors. The amount of net profits is an important determinant of internal savings. Higher the net profit earned by a company, the greater is its capacity to plow back profits. The dividend policy of a company determines the extent to which the profits can be retained for reinvestment in the business. If a company follows a liberal and regular dividend policy, it may end up retaining lesser profits. But if it follows a conservative dividend policy, it has a chance of building up greater internal savings. Another factor is the rate of corporate tax imposed on the company. If the rate is high, then it may have lesser amount of internal savings. The age of a company also influences this amount. New companies are generally unable to retain much profit due to their desire to satisfy the shareholders. The benefits of plugging back of profits are: a company with such reserves can face unforeseen contingencies, capital market crisis and other downturns in the economy with lesser difficulty and ease. Such reserves help to stabilize the dividend policy of the company. It thus helps in improving the company's relations with its shareholders. It even helps in appreciating the value of its shares. It is the most convenient and economical method of finance and involves no legal formalities or negotiation. Now we talk about equity shares. Equity shares are shares which do not enjoy any preferential right in the matter of claim of dividend or repayment of capital. The equity shareholders get dividend only after making the payment of dividends on preference shares. There is no fixed rate of dividend for equity shareholders. The rate of dividend depends upon the surplus profits. In case there are good profits, the company pays dividend to the equity shareholders at a higher rate. The merits of equity shares. There are a lot of merits of equity shares that are from shareholders' point of view. The equity shareholders are the owners of the company. It is suitable for those who want to take risk for higher return. The value of equity shares goes up in the stock market with the increase in profits of the concern. Equity shares can be easily sold in the stock market. The liability is limited to the nominal value of shares. Equity shareholders have a say in the management of a company as they are conferred voting rights. From management point of view, the equity shareholders are the owners of the company. It is suitable for those who want to take risk for higher returns. The value of equity shares goes up in the stock market with the increase in profits of the concern. Now, the limitations of equity shares. From the shareholders' point of view, the equity shareholders get a dividend only when the company earns sufficient profits. The decision to declare dividend lies with the board of directors of the company. There is high speculation in equity shares. This is particularly so in the time of boom when profitability of the companies is high. Equity shareholders bear a very high degree of risk. In case of losses, they do not get dividend, and in case of winding up of a company, they are the last to get the refund of the money invested. Equity shares actually swim and sink with the fate of the company. From the management point of view, it requires more formalities and procedural delay to raise funds by issuing equity shares. Also, the cost of raising capital through equity share is more as compared to debt. Let's now discuss about the preference share. Preference shares are those shares which carry preferential rights in respect of dividend and return of capital. Before any dividend is paid to the equity shares, the dividend at a fixed rate must be paid on the preference shares. However, this dividend is payable only if there are profits. Again, at the time of winding up, the holder of the preference shares will get the return of their capital before anything is paid to the equity shareholders. Now, the types of preference shares. A company has the option to issue different types of preference share: convertible and non-convertible preference shares. The preference shares which can be converted into equity shares after a specified period of time are known as convertible preference share. Otherwise, it is known as non-convertible preference share. Cumulative and non-cumulative preference share. In cumulative preference shares, the unpaid dividends are accumulated and carried forward for payment in future years. Participating and non-participating preference share. Participating preference shares have a right to share the profit after making payment to the equity shares. Redeemable and irredeemable preference shares. Preference shares having a fixed date of maturity is called as redeemable preference shares. Here the company undertakes to return the amount to the preference shareholders immediately after the expiry of a fixed period.
In this video I'm going to give you a very short introduction to the very basics of preference shares. So let's start with the very basic ideas. What actually is a preference share? And the best way to think of preference shares is kind of a hybrid between debt and equity. They're shares, so they're like an equity in a company, but they're also like debt because the company has an obligation to pay a fixed sum to you. And the reason that they're called preference is because you get your dividend first. You have preference over the other shareholders. If you don't get your dividend, nobody does. You're top of the pile for dividends, which has a lot of advantages if you're relying on income. If you're retired and you have to get so much each year, you don't want to have lots of common stocks that don't actually pay a dividend. Where the board decides this year we're not paying a dividend, whereas in preference shares you don't have that problem. However, your dividend is fixed. Usually when you read the name of a preference share, it will say some percentage in its title, and that's what you get. So if the company doubles its profits, your dividend is exactly the same. So over time your dividend will be worth less due to inflation, unless you're adding to your holdings constantly. And normally they have no voting rights, so you're not really a member of the company. You're not, in a sense, an owner in the same way that a common stockholder is. The two big ideas, probably the most important consideration, is whether it is a cumulative preference share or a non-cumulative preference share. So cumulative preference shares means that missed dividends must be paid. So if the company has a bad year or a bad half year and decides not to pay the dividend then, it owes you that money. That becomes a liability to the company. They have to make that up at some point in the future if the company continues to go on. And they cannot pay any dividends to the normal shareholders until you've got your missed dividend and your next dividend. Whereas non-cumulative means dividends can be missed and not paid at all, but if you don't get your dividend, common shareholders still don't get the dividend. And non-cumulative preference shares come with what's called a risk premium. That essentially means that the risk of not paying is reflected in the price. If you're very dependent on income, you probably want to look more at cumulative preference shares because you can feel a bit more relaxed about those. But if you can pick the right non-cumulative preference shares, your rate of return will be slightly higher, but of course you're taking on more risk, so that's not at all surprising. You also have to consider redemption of preference shares. They can be bought back by the company if they're sometimes called callable or redeemable. You'll usually see some sort of date on them. Like you could have, like Bellaway has got, the building company, has got 2014 preference shares. That means at some point in 2014, on a date, they'll be able to buy all those shares off you. Irredeemable or perpetuals can't be bought off you. For example, Aviva has a load of perpetuals, so they can't be bought off you. So you buy those and you will always get that preference dividend as long as the company exists. And one thing that people often don't realize when they first look into these is companies can actually buy preference shares back in the open market. So if you were to sell your shares and the company decided it was buying these back to get rid of it to lower its debts, then it could buy them back, but just off the stock exchange. So they can't buy them if you don't want to sell them. And yield to maturity is what you want to be calculating when you're looking at redeemable preference shares, because you can buy them under the nominal value. So you could buy them for 80 pence when they're worth £1. So when they're bought back, you'd get that extra 20 pence, which would give you a very good rate of return. Whereas, more importantly, if they're trading above the nominal value, when they're bought back, that will be kind of a loss. So you want to work out what your yield to maturity is, adding up all of the dividends that you'll get from it, and then taking the amount of money that you'll get when they're bought back and comparing that with the price you've paid. So give you your yield to maturity, which is a better indication of what your long-term rate of return will be. And preference shares have a nominal value, which is what they pay the interest on, just like you would with bonds. If you know about par value, it's very much the same idea. Normally preference shares have a nominal value of £1. They trade around £1. If they're more than £1, you're paying slightly over the nominal value. If they're under £1, you're paying less than the nominal value. And they only pay the kind of interest on £1. So just start with an example. If you look at the Aviva shares I mentioned earlier, it says 8.75. Remember, this is cumulative, so they can't miss dividends. If they do, they owe you. The IRR is irredeemable preference shares, and the nominal value is £1. Right? And they trade at £1.15, but they're only paying 8.75 pence. You usually read this percentage, just put a pence after it. If the nominal value is 1, percentage and pence can be thought of as the same thing. And since it trades 115p, you're paying 15 pence above the nominal value. You're not actually getting the 8.75, you're getting 7.6%, which is less than that. But if you were lucky enough to be able to buy them for under £1, this particular preference share has it several times in its history traded significantly below the nominal value, then you would be getting even more than 8.75%, which you'd be very happy with. So that's the very basics of preference shares. Hopefully that's equipped you with enough information and go and start looking at them and working out how they fit into your portfolio, or if in fact they do at all.
Advantages and disadvantages of preference share. The advantages of preference shares are fixed return. The dividend payable on preference shares is fixed, that it's usually lower than the payable on equity shares. Flexibility in capital structure. The company can maintain flexibility in its capital structure by issuing redeemable preference shares, as they can be redeemed under terms of issue. No burden on finance. Issue of preference shares does not prove a burden on the finance of the company, because dividends are paid only if profits are available, otherwise no dividend. No charge on assets. No payment of dividend on preference shares, and does not create a charge on the assets of the company, as is in the case of debentures. Widens capital market. The issue of preference shares widens the scope of capital market as they provide the safety to the investors as well as a fixed rate of return. Disadvantages of preference shares. Higher rate of dividend. Company is to pay higher dividend on those shares than the prevailing rate of interest on debentures of bonds. Financial burden. Most of the preference shares are issued cumulative, which means that all the areas of preference dividend must be paid before anything can be paid to equity shareholders. Dilution of claim over assets. The issue of preference shares involves dilution of equity shareholders' claim over the assets of the company because preference shareholders have the preferential right on the assets of the company in case of winding up. Adverse effect on creditworthiness. The creditworthiness of the company is seriously affected by the issue of preference shares. Tax disadvantage. The taxable income is not reduced by the amount of preference dividend, while in case of debentures or bonds, the interest paid to them is deductible in full. Debenture. The companies can raise long-term funds by issuing debentures that carry a short rate of return for investors in the form of a fixed rate of interest. It is known as debt capital or borrowed capital of the company. The debenture is a written acknowledgement of money borrowed. Types of debentures: redeemable and irredeemable debentures. The debentures which are repayable on a specified date are called redeemable debentures. On the other hand, there is no fixed time by which the company is bound to pay back the money in case of irredeemable debentures. Convertible and non-convertible debentures. The holders of convertible debentures are given the option to convert their debentures into equity shares. Secured and unsecured debentures. Secured debentures are issued with a charge on the assets of the company as security. This charge may be fixed, that is, on specified asset, or it may be floating. Secured debentures are also known as mortgage debentures. Registered and bearer debentures. For registered debentures, the issuing company maintains a record of the debenture holders. Any sale or transfer of such debentures must be registered with the company. The merits of debentures. Debentures are secured loans. On winding up of the company, they are repayable before making any payment to the equity and the preference shareholders. The debenture holder gets a short return irrespective of profit. Issue of debentures enables the company to provide high return to equity shareholders when the earnings of the company are good. This is called trading on equity. Debenture holders have no right either to vote or take part in the management of the company, so by issuing debentures, the company raises the additional capital without diluting the control over its management. Interest paid on debentures is treated as an expense and is charged to the profits of the company. The company thus saves income tax. The limitations of debentures. If the earnings of the company are uncertain and unpredictable, the issue of debenture may pose serious problems due to fixed obligation to pay interest and repay the principal. So when the company expects good and stable income, then only it should issue debentures. The company which issues debentures creates a charge on its assets in favor of debenture holders, so a company not having enough fixed assets cannot borrow money by issuing debentures. The assets of the company once mortgaged cannot be used for further borrowing. So issue of debentures reduces the borrowing capacity of the company. Now let's now talk about the working capital. The term working capital has several meanings in business and economic development finance. In accounting and financial statement analysis, working capital is defined as the firm's short-term or current assets and current liabilities. Net working capital represents the excess of current assets over current liabilities and is an indicator of the firm's ability to meet its short-term financial obligations. This meaning corresponds to the required investment in cash accounts receivable, inventory and other items listed as current assets on the firm's balance sheet. In this context, working capital financing concerns how a firm finances its current assets. A second broader meaning of working capital is the company's overall no fixed assets investments. The business uses of working capital. Working capital has several meanings. Firms use it in many ways. Most fundamentally, working capital investment is the lifeblood of a company. Without it, a firm cannot stay in business. Thus, the first and the most critical use of working capital is providing the ongoing investments in short-term assets that a company needs to operate. A business requires a minimum cash balance to meet basic day-to-day expenses and to provide a reserve for unexpected costs. It also needs working capital for prepaid business costs such as licenses, insurance policies, or security deposits. New facilities and equipment are not the only assets required for growth. Firms also must finance the working capital needed to support sales growth. A final use of working capital is to undertake activities to improve business operations and remain competitive, such as product development, ongoing product and process improvements, and cultivating new markets. With firms facing heightened competition, these improvements often need to be integrated into operations on a continuous basis. Directives for lending working capitals by banks. A commercial bank is a business organization which deals in money, that is, lending and borrowing of money. They perform all types of functions like accepting deposits, advancing loans, credit creation, and agency functions. Besides these usual functions, one of the most important functions of banks is to finance working capital requirements of firms. Working capital advances forms major parts of advance portfolio of banks. In determining working capital requirements of a firm, the bank takes into account its sales and production plans and desirable level of current assets. The amount approved by the bank for the firm's working capital requirement is called credit limit. Cash credit. Under this facility, the bank specifies a predetermined limit and the borrower are allowed to withdraw funds from the bank up to that sanctioned credit limit against a bond or other security. Overdraft. Under this arrangement, the borrower is allowed to withdraw funds in excess of the actual credit balance in his current account up to a certain specified limit during a stipulated period against the security. Overdraft facility is generally available against the securities of life insurance policies, fixed deposit receipts, government securities, shares and debentures, etc. of the corporate sector. Loans. Under this system, the total amount of borrowing is credited to the current account of the borrower or released to him in cash. The borrower has to pay interest on the total amount of loan irrespective of how much he draws. Loans are payable either on demand or in periodical installments. Bills financing. This facility enables a borrower to obtain credit from a bank against its bill. The bank purchases or discounts the bills of exchange and provisionary notes of the borrower and credits the amount in his account after deducting discount. Under this facility, the amount provided is covered by cash credit and overdraft limit. Letter of credit. While the other forms of credit are direct forms of financing in which the banks provide funds as well as bears the risk, letter of credit is an indirect form of working capital financing in which banks assume only the risk and the supplier himself provides the funds. A letter of credit is the guarantee provided by the buyer's banker to the seller that in the case of default or failure of the buyer, the bank shall make the payment to the seller. Now in the end, let us summarize what we have learned in this lecture. Concepts of financial and operating leverages are important for evaluating business and financial risk of a firm. Operating leverage refers to the use of fixed costs in operations and it is related to the firm's production processes. The equity shareholders get dividend only after making the payment of dividends on preference shares. The impact of the change in the level of sales on profits is magnified. Preference shares are those shares which carry preferential rights in respect of dividend and return of capital.